What's up, everybody? Welcome back to Brofolio. The S&P closed red for the third straight session. The 30-year Treasury yield just closed at 5.18%. Home Depot beat earnings this morning, and their store transactions still finished down 1.3%. And NATO is openly discussing putting warships into the Strait of Hormuz if it is still closed by July. That all hit the tape on the same Tuesday. Let's break it all down. First on the clock. The close. The VIX climbed 1.35% to close at 18.06. The Dow finished down 0.65% at 49,363. The S&P 500 closed down 0.67% at 7,353. The Nasdaq dropped 0.84%, and the Russell 2000 got hit the hardest, finishing down 1.01%. 3 straight down days on the index. The fear gauge climbing, small caps cracking, and the catalyst that everyone is pointing at is the long end of the bond curve. The 30-year Treasury closed at 5.18%, the 10-year at 4.67%, and the 2-year is at the highest level it has been at in over a year. The last time the US government had to pay that to borrow for 30 years, the iPhone had not been released. Lehman Brothers was still alive. That is how far back the 30-year yield level goes. Now let's talk about the print that mattered today, Home Depot. Home Depot reported before the open. Earnings per share were $3.43 and revenue of $41.77 billion. Both beat the street, and they reaffirmed their full-year guidance. So why is anyone worried? Look one layer deeper. Comparable sales grew 0.6%. and customer transactions came in down 1.3%, which means the only reason revenue grew at all is because people had to pay more for the same trip to the store. Home Depot's management said it directly on the call. Customers are deferring projects. The big ticket renovations, the new deck, the new kitchen, all getting pushed out. That is not a healthy consumer. That is a stressed consumer, and fewer people are walking through the door. Last week, we covered McDonald CEO saying low-income traffic was declining. Today, Home Depot just put a number on it, across the entire home improvement category. When the orange and white box that prints money during housing booms tells you transactions are down, that is the consumer telling you what is in their wallet. Large tech are feeling it in their pockets as well, as layoffs continue to come in to pay for the dream of growth. Meta layoffs go into effect tomorrow, 8,000 jobs. Now flip over to the Fed. Kevin Warsh has been Fed chair since May 15th. Powell stepped down as chair but stayed on the board. First time a former Fed chair has done that since Mariner Eccles in 1948. And the board is bracing for something. Tomorrow afternoon we get the FOMC minutes from the April 29th meeting. That meeting held rates at 3.50 to 3.75%, 4 dissents, the most dissent the Fed has shown in 30 years. And these minutes will be the first window into the Warsh-era direction. The bond market is already trading like it sees rate hikes coming, not cuts. Moving on the growth side, the OECD officially warned today that global growth risks have worsened on the back of the Middle East situation. The administration continues to say we are roaring, but the data says the consumer is on its knees and the bonds are screaming both can't be right at the same time. Moving to AI and private credit. Private credit. Blue Owl froze quarterly redemptions on one of its retail credit funds earlier this year. Mohammed El-Arian called it the canary in the coal mine. Jamie Dimon went on television and said when you see one cockroach, there are usually more. That story has not gone away. It has gotten quieter, which is usually how these stories work right before they get loud again. On the AI side, the numbers keep getting harder to reconcile. Hyperscaler CapEx up roughly 80% year over year. Hyperscaler revenue up 15%. OpenAI is reportedly on the hook for over $1 trillion of compute commitments over the next 8 years. And their last reported annualized revenue was about $13 billion. Let's say that again. $1 trillion in commitments and only $13 billion in revenue. Last thing on AI. All eyes are still on the Nvidia earnings report tomorrow after the close. This print is going to tell us whether the order book on the hardware side can keep justifying the capex on the software side, or whether the bill is starting to come due. Now let's move overseas. Because the foreign desks are telling the same story we are telling here, just louder. Korea first. Today the Kospi gave back about 3%, but the number that should grab you is not the index level, it is the leverage behind it. Korean retail investors now have a record 36.5 trillion won in margin loans, largest in Korean stock market history. At the same time, retail also poured roughly 34 trillion won into a 2x leveraged inverse ETF. That is what classic retail mania looks like. Now Japan. The 30-year Japanese government bond closed today at 4.16%. The 10-year at roughly 2.8. That 10-year level is a 29-year high. 29 years. The Bank of Japan has been tapering its monthly bond purchases for the last 18 months, from 5.7 trillion yen down to 2.9 trillion, and it has not worked. Long-end yields continue to keep climb, and board members are now openly saying they want to hike rates as soon as possible. The carry trade that financed risk assets around the world for a generation is unwinding hard, but the market still hasn't reacted. Moving to commodities and China. WTI closed at $104.36, Brent at $111 and change. Oil basically held the line into the close after Trump backed off a Tuesday strike on Iran at the request of Gulf allies. Gold pulled back from its highs and settled around $4,500. Silver held above $74, and copper slipped for a third straight session, now under $620. The story underneath those prices, the gold and silver miners are running margins you do not normally see outside of high-margin tech. Average gold price in the first quarter was $4,873. All-in sustaining cost for the industry is sitting around $1,525. That math gives miners north of 170% margins right now. Moving to China. China is now the largest direct trading partner for 62 countries on the planet. The US is the largest direct trading partner for 31. The math has flipped. On top of that, China exported a record 131 million tons of steel last year, nearly double what they were exporting 3 years ago. The OECD is now warning that global excess steel capacity is roughly 640 million tons. The China flooding the market headline is not a future scenario. It is the present tense. They are already doing it. And tariffs are not going to stop a country that makes the stuff for the entire planet. Now to the close beat. Bloomberg reported today that NATO is openly considering deploying warships to the Strait of Hormuz if the strait is not reopened by early July. The strait has been blocked since the US-Iran war started on February 28th. There was a ceasefire framework in early April, but last week, Iran fired on a UAE asset, and Treasury Secretary Bessent spent today in Paris at the G7, telling allies to help crush Iranian terror financing. That is not the language of a ceasefire that is holding. That is the language of a ceasefire that is being walked back in slow motion. Watch the language coming out of the administration over the next few weeks. The data does not match the narrative right now. Bessent says no recession, but the University of Michigan consumer sentiment number is at an all-time low. Home Depot's transactions are negative, and hyperscalers are firing thousands of workers at a cyclic rate. When the data and the narrative drift this far apart, the narrative usually gets rewritten before the data does. Watch for the soft landing rebrand, the K-shaped recovery rebrand, the manageable conflict rebrand. Whatever phrase shows up on financial television next. The data is already telling you the answer. The job is to not get talked out of what your eyes can see. Moving to tomorrow's catalysts. 2 p.m. Eastern, FOMC minutes from April 29th. First real read on the Warsh-era Fed. After the close, Nvidia reports earnings. Conference call at 5 p.m. Eastern. Consensus is looking for roughly $78 billion in revenue. That print decides whether the AI CapEx story can keep funding itself. Also tomorrow, Target and Lowe's report. Two more reads on the consumer right after Home Depot. If Target says the same thing Home Depot just said, that is 2 for 2 on the consumer canary. And as we already discussed, Meta layoffs go into effect tomorrow. 8,000 jobs. Be careful, everyone. Right now is not the time to FOMO, with the 30-year being at the highest level since 2007. Home Depot transactions going negative on an earnings beat. Korean retail using records amount of margin. Japan hitting 29-year yield highs. And the administration is calling all of it manageable. That is it for the 19th May recap. Thank you for watching. If you got any value, please like, subscribe, and drop a comment. And I'll see you tomorrow.